Hi there. My name is Christian Dye from Latitude West Financial. And thank you guys for joining. I will be hosting and talking about highest ROI for real estate here in Canada in the best provinces that me and my team have found to invest in. So I'll be showing you what me and my team do. As well, I will be inviting our guests from CPI Capital, Ava Benosaki and August Biniaz, to talk about the US and what they are doing with passive investors for investing in multifamily units. And so I will have an opportunity to talk for the first part, and then I will switch it over and they will talk for the second part. And then we will have questions at the very end. The best way to do the questions is to put it in the chat, and then I will moderate all of the questions at the end to make sure. We will share all of our contact information if any of this information prompts you to want to talk to us personally. So the first thing I want to say is that all of the information here is for educational purposes only. We're actually not telling you to either buy or not buy real estate here in Canada or the US. We're just giving you enough education for you to make an informed decision on your own and to work with your trusted advisors. So I'm going to start. And here at Latitude West, we're a little bit of a different financial we're a very, very different financial firm in the sense that your traditional financial advisors, might be showing you a lot of real estate, a lot of mutual funds and TFSAs and RSPs and things of that sort. And yes, we are able to do that. Yes, we are insurance licensed. And yes, we will do some financial planning for your retirement, for your cash flow, for your family. But we also work a lot with real estate investors, and we attract a lot of people who want that real estate financial advisor, which they're having trouble to find. So if you are a real estate investor, but you do not, want to put all of your money in RSPs and TFSAs, but you want to, buy real estate or invest in real estate, we're probably the right fit for you. So this is our business model, and this is our belief, is that everyone should have stocks and mutual funds of some sort, but also real estate. And then, of course, what we like to call reserve, and that's so that when there's opportunities in the market, we can go into it. All right. So how do we analyze real estate? So the first thing that I want to do is I want to talk about cap rate. I want to talk about cash flow and IRR. So cap rate is essentially one way to compare one property to another, like a $10 million apartment building compared to a, one bedroom, $250,000 condo, which is the better cap rate? Well, they both break it down to a percentage: net operating income minus expenses, not including mortgage, divided by the purchase price. And that will give you this percentage. So we look at cap rate. Cash flow is pretty self-explanatory. All the income coming in from rent minus all the expenses, including mortgage going out. You're either positive or you're negative. And then the IRR is the rate of return. And the rate of return is how we would compare it against, let's say, a stock or against another investment. What is our annual rate of return? So part of this talk is, where have me and my team found where are we looking, and where's the different real estate that we're looking at? So we're going to start with BC. So BC is a tough one because it is so incredibly expensive. So here is an example of us analyzing a property pre-construction out in Surrey. Why Surrey Central? There's a lot going on in Surrey Central. And am I telling you to buy there? No, all I'm doing is analyzing it for you. Does Surrey Central, some sort of a pre-construction, make sense? Well, the answer is maybe. If you were going to go, because UBC has now bought land out there, SFU's out there, there's so much going on in that downtown core. What we would do as advisors is we would say, if this is an area they're interested in, number one, let's analyze it. And number two, let's see what's going to make sense. So if you said, I have got a 20% down payment on something like this, I'll tell you now, it's probably not going to make sense. We're looking at 35% down payment just to get it to break even. And as a long-term rental, it's also not going to work. What we're looking is short-term rental, corporate rental. If it allows an Airbnb, it's the only way this thing is going to make sense. Okay. So here is where we got it to cash flow using essentially a short-term rental model. We've figured out a vacancy rate. We found a management company that would do short-term rentals. So what are the things that we're looking at? We are looking at cash flow. And then here, $32.37. So it's just about break even. Cap rate, 3.91. So now we could use that number to compare it to another. And then we're looking at the internal rate. If we were to hold this property for 20 years, it's at 9.32. So right away, is this a smoking good deal? I would say it probably is not. Okay, it probably is not. If we were to take a look at a rec property, you know, a rec property, maybe somewhere out in, let's say, Whistler, long-term rental, is this thing going to make sense? And the answer is, it is not. 20% down payment, we're looking at almost $3,000 per month negative cash flow on and that's on a 25% down payment on a $2 million property. So you'd say, oh, I definitely don't want to buy this rec property. But if I shift gears a little bit, and I now run it as an Airbnb, for that same 25% down, I am now looking at, for that same 25% down, I'm now looking at a positive $1,500 per month. Now the one thing to notice over here is I put the management fee at only 20% though. Some property so basically that management fee would be a key component. Is someone else managing the whole thing and finding the renter, or are you involved in the process? If you are involved in the process, maybe controlling the calendar, just having somebody else clean it, then that's where the numbers, you know, tend to work. But, you know, in other parts of BC, I would say the Lower Mainland is a really tough place to find anything. You almost have to go a short-term rental. If we go out just a little bit further, we go to Kelowna. A lot of things happening in Kelowna. If you were going to go to Kelowna, I think the time to invest in there was probably, I would say, you know, 2 years ago, minimum. 10 would have been better. But the same thing, what I find is the best bang for your buck that's going to be out in Kelowna is probably going to be anything that you can Airbnb. And then you want to keep that in those summer months is going to be the best. If it's a house, great, but their houses are pretty expensive now. If it's a condo, there's 2 buildings downtown Kelowna that allow full Airbnbs, full Airbnbs. And that model, I think the capital appreciation is going to be there because UBC, Okanagan, has now purchased land in downtown Kelowna. And it's also right beside the lake. So you're either going to get the tourists, or you're going to get the students, or you're going to get the capital appreciation, and then you're just going to sell it. So that's one to look into. When we ran the numbers, again, we were looking at the cap rate, the cash flow, and the IRR. Unfortunately, because of the high price, a higher down payment seems to be what's going to have this make sense. I don't want to. I kind of just wanted to talk about BC. Is BC a good idea or a bad idea? And the quick answer is depends on the area and depends on what you're doing with the property. You know, there are things on the island that are doing very well. So really, I can't go through everything. I'm just giving people some ideas. If I shift to Alberta, that's the other province we're looking quite closely at. You know, when we're looking at Alberta, there's different parts. So if you were to shift gears and let's say go to a place like a suburb of Edmonton, then the houses are, I would say, in the neighborhood of 300, you know, 400. If you got a really small entry level house, you can get something as little as, you know, in the 200s. That needs work though, that needs work. But the question is, can you find this on your own? And if you can, great. If you can't find this type of product on your own, if you went looking right now, he says, you know, everything's in the 300-400s. Me and my team, that's what we do. We find deals. We find deals for our clients. So this guy over here, just comparing to BC numbers, you know, based off of a 20% down payment, we can get this thing to cash flow. We can get a higher cap rate, 5%, and our IRR is at about 15.76. If we want to kind of use a little bit of a different approach, downtown, okay, if we were to go into downtown, certain areas of the downtown core, you know, now we're talking not only Calgary, not only Edmonton, but Calgary. We're talking basically different metropolitan cities over here. We're looking at better cash flows. Again, you'd have to be, this model here is based off of an Airbnb model, and we can get better cap rates and better cash flow. Does that mean you should all run out and do this? No. What it means is you should take a look, work with someone, and try to understand what is the play here. Is it a short term? Is it capital appreciation? Is it cash flow? So a lot of people think that it's a bad time to buy, and the quick answer is it's not a bad time to buy. It just depends on what you're buying. You know, in the suburbs, you can still get 2-bedroom condos for under $250,000 with very, very good rents. And when you take a look at the numbers, these things are cash flowing, and they've also got good cap rates. You know, so different areas are producing different opportunities. And it could be, you know, condos, or could be condos, it could be houses, it could be multi-unit apartment buildings, it could be, you know, industrial. So in different areas, what me and my team do is we take a look at what's the opportunity. Here's a $1 million building. This one over here is in BC. Is this a good idea? The nice thing about anything commercial, of course, is you go through commercial financing. So if you're having trouble getting loans on your own property, then what we might want to do is think of commercial, or think of some sort of a multi-unit. The last province I want to talk about is Ontario. And with Ontario, you know, if you go to Greater Toronto area, the GTA, very expensive, just like Vancouver. But if you think outside of that, and we said, what about that, you know, $800,000 condo in Toronto area as an Airbnb, and let's compare this to a house out in the suburbs. And then you're going to get something very, very different. So this is one in the suburb area. And I like this because there's so many universities in the area. This one over here would probably get, it's a $450,000 house in a suburb, but of a university town. And on its own, it would probably generate about $2,400, $2,500 in rent. But me and my team, what we did is we took a look at it as a student rental. And then, of course, you will want a property manager. We could generate ideas to get much more rent. Now, of course, it was undervalued because it needed some work. So we estimated the renos, and we factored that in for our clients. And this thing is cash flowing like a monster. For sure, it's cash flowing like a monster, but it's a lot of hands-on. You got the renovations that it needs to fix it up. And then, of course, you have to choose who's going to manage this property. The more property manager you get, the less it's going to dip into your cash flow over here. So this one over here has got a 7% cap rate, and those ones are very, very hard to find as well. So what we're doing is, me and my team, what we do is we analyze and we provide a service which is very different than a lot of other advisors. And what we're doing is we are your financial advisors. We are figuring out retirement. We are figuring out how does your TFSAs and RSPs integrate with your real estate. Is it a good idea? Is now a good time to buy? Are you on track for retirement? You know, and when we analyze whether you're on track for retirement, you know, these are probability curves, and they're either going to, you know, land you on retirement on time, or they're not. You're going to fall short. And if you fall short, you're going to say, well, Christian, how can I get on track? Maybe the answer is increasing the amount of investments you have. Maybe the answer is implementing one of the strategies that we can use. Maybe it's sticking your assets in a holding company. But that's the financial advice we would give. We would get you on track with the retirement or the planning that you need, no matter what you wanted to fund. So we find that, you know, if you are if you are investing in real estate because you want to either diversify your portfolio or you want to get out of the volatility of the stock market, then what you want to do is you want to, number one, prepare your financing, get your financing in order. Number two is you want to expand your search. You don't want to just be looking, like if you're from Vancouver area or Toronto area or Alberta area, you want to look outside, because if they said there's no deals out there, it's probably just because you're looking in your one area. And I work with a lot of Lower Mainland here in Vancouver, and they just kind of say, yeah, there's no good deals, so we're just kind of, we're looking at the Fraser Valley, we're looking at Mission, we're looking at, I say you got to expand your search. There's a lot of deals out there, but if you can't do these deals on your own, what you need to do, you can't find these things on your own, you need to make sure you've got the right advisor. If you're working with an advisor and all they're doing is going over your stock portfolio, which is of course down, 10 to 20%, and then they meet with you in another year, I don't think that's a lot of help for the real estate investor. You want an advisor who's going to meet with you consistently saying, here's an opportunity, here's an opportunity. And the other thing that you want to do is you want to be able to have an advisor that could do the math for you, to help to advise you whether what you're thinking of doing is a good investment or not. So to reiterate what I've said before, we're a financial advising team, and we are licensed with insurance. We take a look at your insurance strategy. We are licensed with your investments. We take a look at your RSPs and TFSAs. But where we're so different is the other side of this quadrant, and we either analyze the real estate that you're trying to buy, or we show you and provide you with the opportunities of pretty much real estate which you could not find on your own. And if that's what you need, then I suggest we just start a conversation and we can go over how we could work together. We've got a great team, and our team is able to work with you. And I personally am able to talk to you about how an opportunity would look and what it looks like to work with us. So I'm going to show how to get in contact with me. So my assistant is probably the easiest way. So connect with me at assistant@latitude-west.ca. Assistant@latitude-west.ca. I'm going to put this in the chat. Okay, I will put this in the chat. And then I'm going to now take questions at the end. I'm going to shift this over to Ava and August with CPI Capital. And they're going to be talking about something a little bit different. They're going to be talking about, well, what if I don't want to, buy this real estate, manage this real estate, deal with toilets and tenants, and what if that's not my cup of tea, but I do want to make money in real estate? How can I do that as a passive investor? So let's see. I am going to stop my share here. And I believe Ava and August, are you guys there?
We're here.
We're here.
I will shift it over to you guys. I believe if you want to share your screen and how to get in contact, then you have the ability to do that. But I'm turning it over to you. I will help to moderate. And I guess the first question I'm going to ask is, what exactly is it that you guys do?
No, absolutely. I want to first, thank Christian for organizing this and having us speak. But this also speaks about how much of an educator he is, because he's talking about the services he provides, but now he's brought in another different group that provides a different type of service within the real estate ecosystem. And the real estate ecosystem is so large that there's so many different ways to invest in real estate. So we're here today to talk about passive real estate investment options, being able to invest in real estate passively. Now, there's multiple ways to invest in real estate passively. You could invest in REITs, for example, or in funds. Our model is syndicated investments. So it's project specific. We find one large project is usually an institutional project, and then we present our case to our investors, who are all passive. They come in and fund the equity needed for the project. We sourced the deal, we managed the deal, we executed the business plan, we eventually divest the investment, and then we share the profits with our investors. That's essentially what the syndication model is, and we utilize that model. So
but it all started with one thing.
Yes.
Hi, everybody. Happy Saturday. Really happy to be here with you all. Christian, great presentation. Thank you for all the knowledge there. And yeah, really looking forward to talking about our business model. August and I are going to be fighting over the mic here.
We were joking before the start. I'm like, Ava, I have a lot of energy this morning.
I got a lot of energy
You better jump
too.
in and put me in a chokehold. Otherwise, I'm going to keep talking. So
It all really started with August and I have been combined 25 years of experience in real estate. And we came together and we said, where can we find the best yields for our investors? And that happened to be across borders in the US, in the Sunbelt states. It was just, as August was mentioning, these institutional assets that are worth tens of millions of dollars. Now, of course, we can't buy them on our own. So how can we access these investments that historically were reserved for large investors like institutions, hedge funds, the ultra wealthy, high net worth investors, right? So we wanted to be able to buy these investments, build wealth for ourselves and build wealth for our investors. And we always like to say we want to build wealth like the top 1%.
absolutely, yeah. And there was a few hurdles to jump through. One is being able to buy these large assets in the US, these institutional assets, like Ava mentioned, a large 250 unit apartment building that in the tens of millions of dollars. So you got issues with financing, management, having the right team in place. But you also got regulatory compliance, raising capital from Canadians, raising capital from US investors. And then you got the cross-border tax. You know, that's probably the number one most important questions that our investors ask is, hey, how does the tax work? Will I be double taxed? Do I have to pay taxes on the US? Do I have to deal with the IRS? So a lot of hurdles we have to go through to build this company. But again, going back to this concept of yields that Ava was talking about and the passive nature of our investment, we felt we had a very strong product to provide to our investors. And I want to touch on the concept of yield. So a lot of times you talk about, you know, you hear the word ROI, return on investment. And, you know, Christian touched on IRR, which is internal rate of return. There is a fundamental difference between ROI and IRR. So, and I'm going to make it, make that separation because it's important of why we're focusing in the US. The reason we're focusing in the US is because our investments provide cash flow. Cash flow at times pretty close from day one. So you're receiving cash flow. The property is appreciating, and then we are executing the business plan to force appreciate the asset. So eventually the capital gains are also going to be there. So you have cash flow and capital gains. And I'm going to make a brief comparison between, let's say, two different investment options that exist for investors. You're making a $100,000 investment, and in a 5-year term, both investment options are a 5-year term, and in one of those and both investments yield a 2x equity multiple. You double your money in 5 years on both of those investments. Investment A, you put in 100,000. In 5 years, you receive 200,000. But in investment option B, you put in 100,000, and then you receive $10,000 per year. So you receive $50,000 over the term of the project, and then you get $50,000 when the project is sold in 5 years. When you compare those two investments, where your windfall is either at the end of the investments or it goes through the term of on the second option, it goes through the term of the investment, and then you get a bit of a smaller windfall. The option B actually has a higher IRR because you were able to receive some of your profits earlier, and you could reinvest. So it calculates the time value of money and is basically the velocity of your return. So just wanted to make that differentiating factor. So anytime you're looking to invest in real estate, you want to look at the ROI, but you also want to pay close attention to the IRR because it calculates the velocity of your returns. And US investments provided cash flow from day one. Hence, the IRR were higher in US investments than most Canadian investments, unless you have a strong team like Christian's team. That's who's going to go find the right project for you. And then we're going to touch on the passive nature of our investment. So our group, CPI Capital, we source the project, we source the region, and source the investment. And what happens is it's a passive option. So the investors don't have to get the debt. They don't have to deal with the brokers. They don't have to deal with finding the deal. They don't have to deal with contractors to renovate the project. We do all of that work, and our investors are 100% passive.
That's right. And let's talk about a little bit about the region and how we source certain areas to invest in. So we purchase in the Sunbelt states, and essentially we follow certain growth metrics. And these growth metrics are very important because it's job growth, population growth, income growth, and rent growth. So essentially we try to look for where are there Fortune 500 companies going, where are there being lots of jobs created, where are people flocking to those, obviously, to work in those regions because there's jobs, which means the income is growing, and that also means the rent grows as well. So these are certain key metrics that we follow. So long as you have them on an incline for the last 3 years, you're really bound for a successful investment. We're in the business of renting, so it's really good for us because, as August was mentioning, the US has the highest rental yields in the world. So it's quite exciting when you look at the numbers from all the rents you collect. Let's say we have a 100-unit building. From all the rents we collect, we're able to pay our mortgage, our taxes, our expenses, a third-party property manager, and still have that enough surplus left over to give our investors distributions. And now we do monthly distributions at CPI Capital because we want to put a smile on your face every single month when you receive that cash flow.
And increase the IRR.
And increase the IRR, yes, August, absolutely. And then essentially what we do is we again, as August was mentioning, as you're receiving your monthly distributions, alongside with an update of exactly what's happening in the property, where's occupancy at, what renovations have been completed, what cool events did we hold for the tenants in the property. I send my investors an email every single month giving them an update. You get to kind of sit back, still be as much involved as you'd like by reading an email and receiving those rent checks. But of course, my team is executing the business model and we're trying to force appreciate the value of the asset. So when we go to sell it in 5 years, it's worth much more than it would be.
Absolutely. And let's make a differentiating recognize a differentiating factor between single family and multifamily. Our focus is multifamily. Multifamily is any asset more than 5 units. So we look at institutional multifamily, so 100 plus stores or 100 plus units in a multifamily apartment community. That's the assets that we purchase. And the differentiating factor between multifamily and single family is that single family is assessed and looked at on the comparable approach. Whereas multifamily is looked at on the cap rate or the income approach. So if you can increase that income, you automatically increase the asset's value. Whereas in single family, if you just have a bit of a better tenant and your rents are more than your neighbors, you can't just ask for a higher value for your home. Whereas in multifamily, it's very dependent on that income. So that was another very important factor we wanted to share.
Yeah. And let's talk about really quickly who's our ideal investor, who usually invests with us. Now we do have our youngest investor who's 30, and we have our oldest investor who's 75. But it's usually mostly busy professionals who like to invest with us. They're very busy with their lives. They're very busy with their career. They still want to invest in real estate. They don't really have the time, knowledge, or expertise on where to go and where to find those best yields. So they will invest passively with us. Now we do also have active investors. Maybe you call Christian and say, hey, listen, I want to purchase a property, be hands-on. But I also, want to get my money working over here while I sleep as well. So you diversify and you do both sides. Now our minimum investment is $50,000. So it's just a good way to really diversify your financial portfolio, get some USD cash flow coming in your USD account so that when you're ready to take your family on vacation, you have a little nest egg there. And yeah, we're gonna actually share a deal with you guys that we're currently working on, and yeah, we'll kind of show you how things work.
For sure, and on that subject of well-diversified portfolio, large institutions like family offices, university endowments, pension funds, they have an investment committee and they have allocations. So they make certain allocations to stocks and bonds. They make a certain allocations to real estate, to private equity. it's best as an individual investor for you to look at your portfolio the exact same way. A certain allocation should go to real estate, possibly your primary resident. A certain allocation should go to other type of real estate investments like a rental property, but an allocation should also go into passive real estate options, which, like I mentioned, REITs or mix or funds or syndicated investments like the investment that we have. At no time the advice is to put your whole investment into a syndicated investment, because there's of course risk associated with these investments. But it's great to have a part of a diversified portfolio to have an allocation to real estate private equity, which is the option we offer.
Well said, August.
Should we share our screen and
Yeah,
go
let's
over
please.
a deal that we have, because we're going to very briefly go over it. But what was the process again?
Yeah, you just pick that
Share
one,
that.
share that, and then we're just gonna go play, slide arrow down, and then perfect.
Okay, great. And we don't.
You can exit that.
Okay,
Yeah,
great.
fabulous.
And everybody sees our.
It looks good. We could see it.
Yeah, we're
All
gonna
right.
very briefly. We're not gonna present this thing, but we're gonna go over some important slides. So if you're looking to work, and this is more kind of have an educational component to it. So if you're looking to partner and allocate some of your investments towards real estate private equity or this passive real estate options that that you're working with groups that utilize a syndication model like us. So here's a project in Tucson, Arizona, is a community of single family homes that we're purchasing, 71 single family homes to be exact. But this is an option where a group like us sources the deal, puts it on their contract, does all the underwriting, creates all the marketing, and then we come to our investors and we present our case. We say, why do we believe in this area? Why do we believe to buy this asset in an increasing interest rate environment that we're currently in? What is our business plan? What is our exit strategy? So we present our case. It's a very intimate type of real estate investing, rather than just investing in a fund or investing in a REIT, not knowing who's involved. It's very much hands-on. Ava and I have our investors, personal numbers. We go spend time together, go out on dinners, and it's really us presenting our case and saying why we believe on this on a deal we have live and why we're putting our name and reputation on it. So we'll go over this presentation briefly.
And I just want to say one thing. So you'll see this 71 home single family built to rent community with all double car garages. Look at this as a horizontal multifamily. I just wanted to mention that because we do purchase multifamily and we do purchase build to rent single family rentals, which is technically a horizontal multifamily. It operates and behaves exactly like a multifamily, and we will be renting all of these homes out, and we will be showing our cash flow assumptions to our investors so that they can see what they're going to be receiving as cash flow on a yearly basis as well.
Okay, this is a street view rendering of the project. The disclaimer for you to see.
Forward-looking statements. This is for educational purposes only.
These are some risk mitigating factors. So we go over those important things. It's not a development deal, it's an acquisition deal. We're getting a 12% discount to retail value.
We're making money on the buy, is what I like to say.
We'll just briefly go over this.
Yeah, this is a 68-page presentation. Anybody who would like a copy of it would be more than happy to send it to you. Please
Yes.
keep going, August. So it's a $21 million asset. Again, we're syndicating it. So what we're doing is we're getting $17,500,000 from the bank as debt, and then we're raising $6.8 million. 500,000 is coming from us, the general partners. So we're going to be investing alongside of our investors.
And that's a very important fact because, again, I said it's a very intimate type of investment. When a syndication group comes and presents its case to you as an investor, you say, hey, listen, are you investing in it? You have skin in the game? So, it is somewhat industry standard for the sponsors to be also investing in the deal.
Absolutely.
Keep going, Ava,
You
if
want to
you-
make sure that they are investing alongside you. Yeah, keep going. Then what we do usually, you guys, is we actually prove our case of what we love about the area. We always talk about the area demand drivers, the regions. We talk about the rent growth, like I mentioned. We talk about the population growth. We talk about, where as the asset stands, what is convenient and what is it? I can't talk right now. What's in the area where there's going to be all these people there's going to be jobs.
If there's no jobs, there's going to be no people. People can't pay their rents, right? So
that's right.
Build to rent. We spend the next few slides talking about build to rent, and Ava was talking about how it's horizontal multifamily, single family homes in a community or in a portfolio. They behave just like an apartment building. They're managed the same way, they're operated the same way, they're assessed by the banks the same way. So,
but what's really exciting is because right after COVID, of course, we all know there's much more people working from home, and a lot of people are wanting their own space, right? They don't want to be in a small space anymore, in a unit. They want their own space. They want their own bedroom. They want their own office. So this is a good opportunity for us to step in and say, hey, come rent a house from us. Instead of renting a unit down the street, that's almost the same price, to be honest with you.
And yeah, the next few slides just goes over our case about, because our investors are very educated on multifamily, because those are the assets that we've bought over the last few years. This is a new asset class that we had to kind of provide that education to our investors and prove our case about BTR SFR.
A lot of people are being pushed out of being able to afford a home right now because of the increasing interest rate environment. So again, what's a family to do? Go rent a unit or come rent an actual home from us here?
This is another rendering from the asset. I think this is an important slide, and there's a lot of education that goes into this slide. So the image that you see on the right-hand side is called the capital stack. The capital stack really outlines how the profits that a property, that an asset makes in an investment are distributed. So any profits that a property makes, first it has to pay its debt obligations to a mortgage. And you can see at the bottom here, always at the bottom of the capital stack is the debt. So that any profits that a property makes, it has to pay its debt first. And then in our case, the next people who get paid are the Class A investors. These are investors who don't want to take any risk, and they want to get paid right away, but they don't participate in the capital gains. They just get their 10% preferred returns. And then after the debt has been paid and Class A investors have been paid, the Class B and C investors will get paid, which on the next page we'll go over it. Anything else you'd like to? And then after all of that, the general partner, who's us, gets paid. And that's a very important part of this business, which is the real estate private equity or syndication business, because essentially the investors are passive. It's not a joint venture. The investors are coming in and they're trusting the general partner, the management group, to do everything and have the final say. So if there's that much trust bestowed on us, it's important that our profits is performance-based. Okay, great, August and Ava, you're going to bring this great opportunity and you talk about how great it's going to be and how it's in a great region. But what if the deal doesn't perform, right? It's important that our compensation is performance-based. And that's why we get a portion of the profits. So the profits are split 70-30 between us and our investors, 70% to the investors, 30% to us. But if there's no profits to be made, we don't make any money. So it's important for us to bring great deals to our investors, execute the business plan, perform, so then we can earn the profit and living. Anything else you'd like to go over?
Yeah. I'll if you go to the next page here, we really did a 3-tier equity structure. So it's kind of cool what we do here for investors. They get 3 different options to choose from when they want to invest with us, as August was mentioning. And now you see this line and it says, so we have the minimum investment right here, Class A, B, and C. And we have this preferred return line right here. And this is where August was just kind of mentioning performance.
I don't think they can see your cursor, but go ahead.
Yeah, we have the preferred return here. And this is where August was mentioning the performance base. So it's quite cool how we structure these deals. So our investors have to receive their preferred return on a yearly basis. So 8% per year for 5 years, because we hold these projects for roughly 5 years. They have to receive 8% first before we do that 70-30 split. So once you get 8% for the 5 years, then we go ahead and we split the remainder of the profits by 70-30, 70% going to the investor and 30% coming to the general partner. So it's the investor gets paid first, and then we do the profit
And
split.
those preferred returns are cumulative. What that means is, hey, August and Ava, CPI Capital, you promised us to make 8% in year 1, but we ended up only receiving 6%. that 2% is actually owed to you and have to be paid to you next year. And let's say the year 2, you only got 8%. That 2% from year 1 is still owed to you. So
I'll touch on that on the next slide.
Sorry.
Yeah, definitely. But very, very well said, because that's a very important part. So what we do here is we actually show the average annualized returns, or the IRR, as August was talking about before. So we have a Class C investor as a $50,000 minimum investment, USD. So you open up, you can call your Canadian institution and say, hey, please open me up a USD account. It's as simple as that. And then all the returns go right back into your USD account. It's a 7% preferred return, and it's a average annualized return over the 5 years of close to 27%. Now that's with the cash flow and the profits made upon sale. Class B investors, 8% pref and close to a 30% average annualized return. And again, the Class A, it's more like a private lender. You're getting your 10% per annum, but you're not participating in the back end profits. This is the cash flow assumption. So what August was saying is year 1 on Class B and C investors, you don't make any cash flow because the properties have not been rented out yet because they're being built. In year 2, so we actually owe you 8% for the Class B investor. Well, we owe it to you in year 2 now. So year 2, we owe you 16%, but we're only paying you 3.3, and it keeps adding up as the years go on, and eventually it gets paid out on the back end.
Everybody's talking about the middle box here.
For the Class B investors.
Yes.
Perfect. We can go to the next slide. So you can ask any questions that you have, but we structure each deal the same. So usually investors, when they come back to our deals, they're very familiarized with how this all works. And then we do a return summary sensitivity analysis. So Christian was talking about cap rates before. So we always say, hey, if we exit at this cap rate or this cap rate, this is going to be the returns on the back end. So that's essentially how our properties work. And again, this is just
we make our case about the region, why we believe in Tucson. We talk about all the jobs, and we provide lots of data. We again going over the proximity of the asset from all these area demand drivers. Again, jobs are the most important part of our business, because without jobs, our tenants, our renters can't pay their rent. So it's important there's lots of jobs in the area. We make our case about the jobs. Again, these are very important slides about the jobs that exist in that area.
Is there a hospital nearby? Is there an airport? Is there a university?
Costco, Walmart.
Walmart. All of this fun stuff.
Yeah, I just want to be respectful of the length of our webinar. Do you guys want to maybe put how to contact you?
Yes.
I thought if we I guess you've done an amazing job in detailing all of the aspects of your deal.
Thank you.
Yeah, so there is a email address, and there is a QR code, and there even is a phone number there. What I find is that both you and myself are just planting an idea for investors, and we're giving them the opportunity to connect if they so choose. What I've always said is these are educational webinars. If you take the education and you can do something with it on your own, well, that's great. We've actually hit our job. And if the idea is looking at real estate, outside of BC or in different ways inside of BC, then that's great. If your idea is maybe saying, I'm open now to the idea of investing down in the US, then that's great. But if you find that you like both of those ideas, but you can't do it on your own, then that's where both you and I come in. I'm more on the advising side and helping people to integrate their financial plan with their real estate investments. And you guys are basically another diversification of people with cash, where they like the idea, but they don't kind of want to be hands-on, and they want better returns, or maybe they already have a lot of things in Canada. So I invite people to connect with CPI Capital, and this is how you would, get in touch with them. As well, you're invited to connect with myself, and I put my email address and my assistant to set up a call inside the chat at assistant@latitude-west.ca. But if there were any questions, putting them inside the chat now would be the time in order for us to finish on time. So if you have a question that you want to formulate for Ava, August, or myself, feel free to put it in. But I guess I will start off a question for you both, and that is, what are you finding is the climate with the new kind of higher interest rates on the effects of real estate in the US? Has it slowed down similar to the way we've slowed down? Or is supply still quite low that people are still buying?
Yeah, no, it's good. Great question. Obviously, as I mentioned earlier, we're in an increasing interest rate environment. We have to factor that into our underwriting. An option that exists on commercial real estate purchases and commercial real estate debt is this. It is an interest rate cap. So it's an actual insurance policy you can purchase. Now there's a premium that needs to be paid for that insurance policy, but you can purchase a strike, as is known in this space, is that and you buy an insurance policy where if the interest rate go above that spread or above that strike point, that you get reimbursement, and you will not have to pay for that amount. But again, you have to raise enough capital to be able to purchase that interest rate cap. So we're purchasing an interest rate cap for our bridge debt, which is going to be for the first 2 years. And then we also have to do some predictions of where the interest rates are going to be in 2 years when we switch from our bridge debt into the permanent agency debt. Now, that's kind of how we're mitigating the risk when it comes to the increasing interest rate environment that we're in. We also have to make sure that at the time of refi, we're not taking any cash out, that we're doing it at par refi, which again keeps our cash flows high if we are in a high interest rate environment at that time. Now, how interest rates are really affecting the market and the economy, we know that inflation is very high both in Canada and the US. The Fed and Bank of Canada, they really have one tool to fight inflation, and that's increasing interest rates. And they both have been increasing interest rates astronomically. It's the fastest interest rate increase since the 80s. But they can't continue this because it's going to not only have a national effect, it's going to have a global effect on the economy worldwide. So at some point, they need to stop increasing the rates, and the environment is definitely different than it was in the late 70s with Volcker at the reins at the Fed. So it's a different environment these days. So I don't see the interest rate going up to the way it went up in the late 70s, up to 20%. The income to asset price, the income to medium home price is totally different than it was back then. Overall, I feel the interest rates will taper off here in Q1 of 2023, and they will start actually reducing, which brings back the economy in a better place. So I believe we're in a somewhat of a quasi recession. Moreover, I feel that currently the economy is already slowing down. The job market is still very strong, so it's kind of a bizarre situation we're in because we're in a quasi recession. That's really my prediction when it comes to the interest rates and the environment we're in and what's going to happen in short term and possibly long term.
Yeah, our team analyzes the data as well, of course, listening to the economists and filtering it for our clients. And we have something similar on the interest rates. Our prediction, and there is no crystal ball out there, but our prediction is following along with what the Fed is trying to do. If they can get interest rates under 3%, if they can get inflation under 3%, then interest rates, we believe, will actually start to go down. Until the end of 2022, 2023, interest rates will continue to go up. Then it will taper. The earliest that we are forecasting that interest rates would start to go down is Q4 of 2023. So we think it will go up, it will kind of stabilize, and then we'll see it'll go down. And I think you kind of hit the nail on the head there, that they cannot keep raising them forever, because then, of course, we're going to go into a deep recession. And what we're going to need is for them to lower the rates to start to stimulate the economy through things like real estate. So I believe that we're actually in a good position to take advantage of real estate environment right now on my side. So we're seeing properties that, you know, out in Alberta that used to be, you know, low sixes, and now they're ending, you know, in mid fives and low fives. Vancouver is a bit of a harder nut to crack, you know, and now we've got these, you know, $2.2 million houses, and maybe they're now 2.1, and people, you know, aren't having much wiggle room on that price because they already feel that they're losing money. I think it's kind of like turning a cruise ship around. It's slow, and it's usually when the economy is down, or if the market price is down on housing, most of the sellers need 3 months for it to not sell, for them to realize I now have to adjust my price. The only people that really are selling quite rapidly are the ones who are able to adjust their price quickly and put the deal together. But for me and my team, we're helping our clients to kind of not only help them to find areas where there are deals, and not only to find actual deals for them, but we're also helping them to negotiate what's going on in that deal. So alongside their realtor, of course. But when we take a look at, you know, somebody saying, you know, it was, you know, let's say 600,000, and now they've gone down to 500,000, but it still needs another 40,000 renovations to get this thing up and going. Oftentimes, we're able to build that into the offer when they adjust the offer. So we bring it down even further and say, you know what, there's our other opportunities that I'm looking at. I'm just an investor. It's not a home that I'm gonna live in myself. And here's, you know, 2 other properties, 3 other properties that I'm looking at with Christian and his team. So they're able to kind of walk away from a really good deal. And then all of a sudden, when the realtor and the buyer realize that, the seller realize that, they often, you know, will throw a larger discount because they know there aren't that many people that have the capacity to be able to buy right now because interest rates are high. But
great point.
Yeah.
Great point.
Yeah. Well, you know what? If there's no more questions, like I said, everyone has our contact information. We put it here in the chat. Ava, AVA at cpicapital.ca, and then myself at assistant at latitude-west. .ca. So what I want to do is I want to finish off early. I want to thank you guys for coming out and educating us. For those of you who are in the live attendance, usually we still send you the recorded link because we encourage you to share it with, you know, a family member or a friend and said, hey, why don't you listen? We've got some really great information here. And then for those of you who are listening to the recorded link, of course, we invite you to reach out to us if there's anything that we've said that has prompted you to be interested in having a further discussion. And remember, we're not here to sell you on anything. We're here to educate you. And I think both CPI Capital and myself have been in business a while because of that. We want to work with the person who's ready to work with us. We definitely don't want to work with everyone just because not everyone is suited for what we're trying to do. But if you think that what we've done, you know, fits with your investment strategy, then we ask that you reach out. But besides that, it's a Saturday. I hope you guys have a good rest of the day, and I hope everyone listening has gotten some great value from this. So I will end this off over here, and I'll wish you guys a very, very good rest of the weekend.
Thanks, Christian. Have a wonderful weekend, everybody.
Thank you, everyone.
Thank you so
Have a great
much.